Good day, ladies and gentlemen. It's my pleasure to welcome you on behalf of Linc Limited and SKP Securities to Linc Limited's Q2FY24 earnings webinar. We have with us Mr. Deepak Jalan, Managing Director, Mr. N.K. Dujari, Director of Finance, and Sanjeev Sancheti, Virtus Advisors LLP, IR advisors to the company. We'll have the opening remarks from Mr. Jalan, followed by a Q&A session. Thank you, and over to you, Deepak ji.
Ladies and gentlemen, esteemed investors, Namaste and a very happy Diwali to each one of you in advance. Thank you for joining us today for our Q2 FY24 earnings call. We appreciate your continued support and trust in Linc Pen. While it is true that we face challenges in the second quarter, particularly in some key export markets due to geopolitical reasons, that Linc Pen has a proven track record of delivering exceptional performance. We have consistently outperformed in the past few quarters, and we strive to do the same in the upcoming quarters as well. As we appreciate your concern, I have deliberately kept the opening remarks shorter so that we can leave more time for Q&A. In the face of these challenges, we managed to achieve it in the domestic market, showcasing the resilience and strength of our brands. Furthermore, our proactive efforts to explore new export markets have already started to bear fruit, and we are optimistic about the positive impact these initiatives will have on our future revenues. I also want to reiterate and emphasize a strategic shift in our product positioning that has been pivotal for Linc. The success of Pentonic gave us the confidence to venture into higher price brackets, and we subsequently launched Pentonic BRT, a retractable ball pen at ₹20, which is still in its growing stage. Building on this success, we are actively enhancing our product portfolio by introducing offerings in the ₹20 to ₹40 price range this year. The move is part of a strategy aimed at meeting the evolving needs of our customers and aligning with market demands. We have several innovative products in the pipeline, which, despite the delays, hold tremendous potential. These products are not just launches, they are game changers. As we move forward, our focus remains steadfast on delivering these products to the market as early as possible. So far as reach expansion is concerned, I would like to reiterate our strategic vision for the future. We had set an ambitious goal of 500,000 touch points by the end of, and I'm pleased to announce that we have made significant progress, reaching about 2.5 lakh touch points today. As we analyze our approach, we have gained valuable insights, and we recognize the importance of focusing on the quality of our touch points rather than just the quantity. In this spirit, we have decided to prioritize these 2.5 lakh outlets every month. By ensuring their active participation, we will not only maximize our impact, but will also optimize our resources effectively. This strategic shift will enable us to build stronger, more meaningful relationships with our retailers, enhancing our overall market presence and driving sustainable growth. Our approach will yield remarkable results, strengthening our position in the market and laying a solid foundation for our future expansion endeavors. Before we conclude, I would like to draw your attention to a noteworthy aspect of our financials. You will observe some increase in the employees' benefit expenses compared to the previous quarter. I want to provide some context. Besides July being our annual increment cycle, about 1 crore is dedicated to a one-time loyalty bonus for our employees who stood by us during the challenging times of COVID-19. This decision reflects our commitment to nurturing a supportive, loyal, and motivated workforce. In conclusion, I would like to express my sincere gratitude to each unwavering support and trust in our company. Despite the challenges we faced in this quarter, your confidence in our vision and resilience has been a driving force behind our efforts. As we navigate the current landscape, we remain steadfast in our commitment to innovation, operational excellence, and strategic growth. We have a clear roadmap, a dedicated team, and a passion for what we do. Together, I'm confident challenges, capitalize on opportunities, and continue to deliver value to our investors. Now, I would like to hand over the call to Mr. Tujari to provide updates on financial numbers. Thank you.
Thank you, Mr. Jalan. Good afternoon, ladies and gentlemen. Many thanks for joining the Q2FY24 Linc Limited earnings webinar. I will give a brief overview of the financial numbers for the quarter gone by before we open for Q&A. 24, the company's operating income grew by 3.3% from rupees 126.98 crore in Q2 FY23 to 131.22 crores. Moreover, operating income for Q2 FY24 increased quarter on quarter by 17.3%. On the gross profit of the company, the gross profit of the company stood at 38.11 crores as against 38.75 crore in the Q2 FY23, and the gross profit margin for Q2 FY24 was 29% in Q2 FY23. The contraction of margin is on account of lower exports, which was relatively higher margin than the domestic, which has relatively higher margin than the domestic market. The operating EBITDA stood at 12.59 crores as against 15.57 crores in the Q2 FY23, and the margin stood at 9.6% as against 12.3% in the Q2 FY23. As mentioned earlier, the decline in the margin is on account of the fall in GP margin and one-time loyalty bonus given to the employee. Q2 FY24 PAT stood at 7.71 crores as against 9.56 crore in the previous year, same quarter, and as against 7.39 crore in the Q1 FY24. The PAT margin stood at 5.8% in the quarter gone by as against 7.5% in Q2 FY23 and 6.5% in Q1 FY24. The company continues to use its free cash flow judiciously, and in the process has been able to reduce its net debt significantly from a net debt of rupees 62 crore in FY19. The company is now debt free with a free cash flow of 5.99 crores as on 30th September 23. We want to provide you with a transparent overview of our revenue projections. Throughout the last financial year, our consistent growth led us to revise our initial revenue guidance upward. This decision was based on our strong performance and the optimistic outlook at that time. However, in the spirit of prudent management and mindful of the current market trends, it is crucial for us to remain adaptive and responsive. Therefore, we have decided to revise our revenue growth guidance for the medium term to the range of 17 to 20%. During this period, the share of Pantonic revenue is expected to grow to around 40%, while Delhi is expected to contribute around over 10%. Further, in the medium term, we expect our annual operating EBITDA margin to expand by 150 to 200 BPS. With judicious use of debt, we also expect ROI to be about 21%. We continue to remain focused on our long-term goal of sustainable growth, profitability, and strong delivered balance sheet. With this, I leave the floor Q&A. Floor open for Q&A. Thank you.
Thank you, Dujari. Friends, we open the floor for Q&A. Anyone wanting to ask a question, request you to raise your hand and we'll take it up. We'll wait for a couple of minutes and so that some questions can be lined up. Okay, the first question is from Vedic Bafna. Vedic, please go ahead.
Thank you for the opportunity. So my question is regarding the revenue front. So going forward, as you stated that you expect a 17 to 20% CAGR growth going forward. So how do you expect that to grow differently?
So, Vedic, even though on export front, in the first half, or particularly in the Q2, we lost on account of two particular countries, where there was unprecedented challenges. So one was Myanmar, which is our largest market due to the foreign exchange crisis and political crisis. Of course, it's been there for a couple of months. So we lost heavily in that market in the Q2. And then the second market was Sudan, where the war, because of the war, we lost in Q2. So these two particular markets, they affected our business, particularly. And so mitigate these losses from these two countries. There are few new markets which we have recently opened. One is the North America, where we have been investing for last 5 years to crack that market. I mean, we invested almost $500,000. I must have mentioned this earlier also. In these 5 years, by participating in various trade shows. In the Q2, we signed an agreement with a national distributor there, and we have ambitious targets with the distributor, and we have already made one shipment in the month of October. That was the first shipment went to the distributor in the US, and we hope that this a new customer, apart from some other countries, where our business has started, we will be able to by the time we end this financial year. So, so if we talk about this year, there may not be any growth compared to last year. Like last year, we had 100 crores of revenue, export revenue. So this year, we will be able to, recover the loss and say almost flat on the export front and not negative. So on export is going to be flat, but on the domestic front, we would like to make up the loss of exports and try to grow anything between 15 to 20% in this year. So, but next financial year, we believe that the new initiatives, as I mentioned about the US market and some other markets, we should be able to catch up with the growth momentum in exports also.
Sure, sir. And sir, launches that the company has planned. So what are their growth plans for the new launches in the domestic market? Like how are we going to launch? Which will be our target area? Any guidance on that?
Certainly, I like to brief on that. I'm sure this will take care of many questions. Yeah. So we've already explained in our yesterday's presentation, investor presentation, that there are a couple of products which are lined up for launch. As a matter of fact, many of the products in Q1 and Q2 have actually shifted, because of the initial hiccups. So, so there is a product which is a 40 rupee retractable gel pen, which we actually test launched in Q1, and then we had some improvements. So in the Q2 we launched it in some more markets. Continuing to be still, it is yet to be launched pan India. Since this 40 rupee pen is the first time that we are launching a product at that price point, we are being a little cautious in going pan India. So it will take another, I would say, another 2 quarters to go pan India for this product. So by Q4, we'll be launching this product, all India. Then there is another product at actually a variation of our original 10 rupee ball pen, which we have recently launched in October. Again, this was supposed to be launched in last quarter, but because of delay, we launched in October. So this product will go pan India by January. So it will take about 3 to 4 months. And then another product we have launched in October, which is at 20 rupees, which is also a variation of our existing Pentonic 20 rupee pen. So this was again months, and finally we launched it in October, and again it will take another 2 to 3 months to go all India. And then we have another 2 products, new products at 20 rupees and 30 rupees, which would be ready for production within December, but we have decided to launch those products in Q4 or first quarter of next financial year, because we do not want to compromise on our ongoing launches. So this is the new launch program. Apart from these, there are a few products still under development, which we hope to launch in early of next financial year.
Sure, sir. And so my
Vedic,
yes,
Vedic, can I request you to join the queue again, because there are a lot of other participants with questions.
just one last question.
Sure, go ahead.
So, sir, my last and final question is on the margins front. Going forward, how do we expect the margins to shape up for the Pentonic side, the 20 rupee pen? How much would be our gross margin for the 20 rupee pen and the 40 rupee pen?
So see, the margins are similar. I've also mentioned earlier that for any Pentonic ball pen, we begin with at least 40 to 45% gross margin. So whether it is a 10 rupee product or a 40 rupee product, the margins are in that range. And so far, improvement in overall margins is concerned, I would like to say that we, in the medium term, we like to improve it by 150 to 200 basis points.
Sure, sir. Thank you. This is helpful.
Thank you, Vedic.
Yeah.
Thank you, Vedic. Friends, may I request you to introduce yourself and the company which you're representing before you ask the question. The next question is from Pratik Dedhia. Pratik, please go ahead.
Hi, so I'm an individual investor. My question is towards the one-time bonus that you had given. Any guidance on, I know the bonuses for the employees who've been with you for the longer time, but any guidance on the forward-looking part if you foresee anything in the future?
There is no such plan, but Pratik, if we ever decide to have such, bonus, we will definitely have a advanced guidance for that. So right now, it's just nothing on cards.
All right. Okay. And one follow-up question that I had was regarding your margins. So I know you mentioned about increasing margins. Can you just give more guidance in what would lead to the
Certainly. So, as we've also mentioned in our earlier calls, that Pentonic compared to our legacy products has much higher margin, and since all our products, future products are under Pentonic portfolio, which are all the higher margin products. So as the share of Pentonic increases in our overall product basket, that is going to help us gross margins. Apart from, of course, the operating leverage with the growth.
All right. Okay. Thanks.
Thank you. Thank you, Pratik.
Thank you.
The next question is from Bhavya Sonawala. Bhavya, please go ahead.
Am I audible?
Yes, you are. Please go ahead.
Yeah. Hi, based out of Bangalore. So I just have 2-3 questions. So first, I want to understand in terms of Pentonic, what factors guides the sale apart from the region and touch points. I just want to understand in terms of our 10 rupee, and we're going to go ahead with 20 and 40. But just to get an idea from you, what are we thinking in terms of what will drive the growth? Because is there anything going to be? Is there any stark difference between a 10, 20, and a 40 rupee in term apart from the design? So how is that going to work?
So, Bhavya, Pentonic has a first mover advantage. We've already discussed earlier that Pentonic actually brought the change in the industry to, with the launch of this 10 rupee product, where the industry could have a adequate margin. And by design, and we invest a huge amount of money to develop any Pentonic product, and which are unique in design and quite differentiated from the competition. So as a matter of fact, the competition is following Pentonic designs, and so whenever we launch a new product, our design is unique, and we carry that first mover advantage. So I think that is the only reason that we have such a great following for Pentonic. Apart from whatever we invest in promotion or advertisements of Pentonic, which is is kind of a premium positioning, even though it is only a 10 rupee or a 40 rupee product, but the positioning is very aspirational. That is another reason that people, our consumer competition. Although in this price segment, our category is very brand agnostic, but still we get some preference, and as the competition intensifies, we have to make higher efforts. But apart from the distribution reach, this is what we try to position the Pentonic brand.
Just you've spoken about design. So is this whole design team in-house, or have we outsourced any of this design for particular pen or?
So all our Pentonic designs are outsourced from Korea, which I also mentioned earlier, and we have a exclusive designer which is only exclusive to Linc and no one else.
Okay, so you said Korea, right? Korea.
Yeah. Yes.
Okay. Okay. Just a last question in terms of our channel of the trade channels we have. By let's say in 2 years, 3 years, how do you see our trade channels moving? General trade will always dominate in terms of because it's a impulse buy sometimes, or it's a 10 rupee small purchase.
Yeah, so you're right. Absolutely. The traditional trade or the general trade, which we call it, is going to dominate for at least many years to come. But definitely, so far e-com is concerned, the share of e-com is going to increase, if not rapidly, but consistently. And I was actually surprised to see the growth in quick e-com of Blinkit. So the sales in channels like platforms like Blinkit is growing quite rapidly for us. E-com is going to grow, but traditional trade is going to be still dominating.
Understood. Understood. I have a few more questions. I think I'll come back in line. If,
Sure, yeah.
Yeah.
Thanks, Bhavya. Appreciate that. The next question is from Shrinjana Mittal. Shrinjana, please go ahead.
Hey, hi, thank you for the opportunity. So I have two questions. So one is on the Pentonic sales, right? It's not grown. And in terms of the share, it's around 31%. And last quarter, Pentonic share was 37%. So our understanding has been that Pentonic share will grow over time. So this quarter, what is the reason for a slightly lower growth in the Pentonic segment?
So, Shrinjana, in terms of if you see that so far absolute volumes are concerned, it's almost flat. It has not degrown.
Right.
But as you know that huge export deficit. So
Correct.
which also includes Pentonic sales. So
Right.
that's the reason that you see overall contribution lower.
Understood. So majorly it's export driven. And so on the export side, how much would be the delta between the export contribution this quarter versus last quarter? Because we have a drop. So just wanted to understand the quantum of the drop.
The quantum of the drop I've already mentioned, that is we have 28% growth in the quarter 2 compared to last year same quarter.
So we have
we have a degrowth of about 28% in exports.
Okay.
Compared to last year same quarter.
Same quarter. Okay, got it. Okay. Thank you.
Thank you, Shrinjana. The next question is from Bhavin Cheda. Bhavin, please go ahead. Bhavin, please unmute yourself and go ahead.
Yeah. Hi, good afternoon, sir. This is Bhavin from Inam Holdings. Can you give the exports actual number for this quarter and Q1? Because I think you give in the presentation the first. What was the exact number in Q2 and Q1?
18.1. Q2. 19.1 it is in Q2, and what is in the Q1? 18.9. 18.90.
Volume. No, the absolute export in crores.
Value-wise,
Yeah.
okay, yeah. So it was 18.9 crores in the quarter 1,
Right.
and in quarter 2. So altogether, it is like about little less than 40 crores in the first half.
Okay. And you said that in value it grew by 28% on YOY in September, right? In this quarter?
YOY Q2.
Q2 to Q2 YOY.
Okay, sure. Second question on your capex plans. If I see majority of the capacity expansion is coming in FY24.
In FY24 we have some capex,
But the capacity will be available.
but we are building the infrastructure, so the capex is going towards that. But eventually, the production capacity will be enhanced in FY25.
Okay. And that would be in the first half or the later FY22? Because I think you still maintain your 750 crores top line guidance for FY25. So I'm factoring a big jump in capacity utilization also, because your current capacity utilizations are running at more than 90-95%, right?
Yeah, so Bhavin, I think you missed the part of the statement by Mr. Dujari that we have revised our guidance from 750 crores to 17 to 20% of our CAGR in the medium term. So there is a as you know that we also have outsourcing. So we have already tied up our outsourcing for our targeted requirement. So it shouldn't be any problem.
Sure. Okay, thank you, sir.
Thank you, Bhavin. Yeah.
Thanks, Bhavin. Sorry. The next question is from Chinmay Nema. Chinmay, please go ahead.
Hello, I'm audible.
Yes.
Hi, Chinmay. Yeah.
Hi, sir. I have two questions. Firstly, could you give some insights about what are the typical barriers to entry when you look at a new geography? So, how much time will it take to get established, and what are the challenges that you see? And secondly, it's a larger question around the turnaround investor material. I read that a consumer who used to pay 5 to 25 rupees for a pen 20 years back can easily pay 30-40 rupees for a pen today. So is it that we are taking a price hike on the same quality of pen, or are we letting go of that product segment and premiumizing the mix? What is it that we're exactly doing?
Really, so sorry to say that I think there is some problem with the audio at your end, so it's not really clear to me what were your questions. So could you just moderate your speaker volume a little bit, and so that I can have a clear voice.
Chinmay?
Is it better now?
Yes, it is.
Yeah, go ahead, Chinmay.
Chinmay, if you're speaking, we can't hear you. Chinmay, we can't hear you.
Okay, let me fix my audio and get back in the
Sure.
Please adjust the audio.
Yeah.
Okay, we take the next question from Jagveer Fauzdar. Jagveer, please go ahead.
Thanks for the opportunity. So, sir, in the first half, we have grown by around 8% in the revenue side.
Right.
So, this guidance of 17 to 20% is this year also or not? By 24.
So certainly, we have to make up in our second quarter, which our belief is that, as I mentioned, that there were a few new launches, and So that is another reason that our H1 revenue growth is mediocre. So we hope to make up the loss in the second half, and even traditionally, the second half is much bigger than the first half. So we believe that we will be very close to our medium-term CAGR growth guidance.
What sir, second question is related to the long-term EBITDA margins. So Flair is also in the same price bracket like Linc or Pentonic.
Okay.
So in the case of Flair, EBITDA margins in FY23 was around 21%.
Okay.
And we have EBITDA margin around 13% or 12%, and we are guiding for the 15%.
Okay.
So what is the difference between us and the Flair pen? So much difference in the margins.
Yes, Jagveer, you have a very valid point. Also faced in our last earnings call. I have no hesitation to admit that Flair traditionally they have a better product mix than Linc. While Linc only launched a 10 rupee pen in 2018, Flair has been selling a 20 rupee pen for a very long period. And apart from that 20 rupee pen, they also have Hauser, where they have much higher priced products. So yes, they have a better product mix, and which we have only recently started. Largely we were a below 10 rupee the price company, but after Pentonic, we are now launching products at 20, 30 and 40 rupees. So yes, at least we have some bank credit cautiously when we give our guidance. So yeah, so I like to still maintain that we would improve that 150 basis to 200 basis points over what we achieved in the last financial year. But yes, definitely there is a benchmark.
Yeah, and
Okay,
also that Linc Flair is in size is larger than us, so they obviously have a larger
Operating leverage also.
Play.
Yes.
So
Yeah.
that's 150 basis points will be to that account.
So sir, another question is again related to the another competitor. This is the Cello brands, not the they launched the Uno Max in Indian market. It's like the Pentonic pen in the design.
Right.
So, but my question is related to the export. So they have launched the Uno Max brand in 2019,
Right.
and they have done pretty well in the export side. They are very good in the export, and they have done a very sizable revenue, even better than us in the export side.
Right.
So what is the strategy they have?
Yeah, so Jagveer, absolutely on dot. You must be aware that Cello was the #1 brand before it was acquired by BIC of France. So long experience both in the domestic market as well as in the export market. And like Flair, they also had a much better product basket than Linc. So, and when they launched Unimax, they started with exports only. So their entire focus was on exports because they could not launch in India due to the compete clause. So their focus was on exports, and they had already existing network in exports. And as you know that the margins in exports are also higher. So yes, they did a great job so far exports is concerned. Although a significant part of their exports is under the third party brand, but nevertheless, they have a a better margin than Linc. Yes, so yeah, I think we are taking note of that definitely.
And the last question related, we have did some acquisition in the African. So how is the progress in the African market? So it's also a very big market for the stationery.
Yes, yeah. So we are yet to bear the fruits of Africa market, and going forward, I'm sure is going to help us.
And we are not getting the Pantonic 40 rupees wala in Delhi. I have tried many times.
So as I mentioned, that no, we are yet to go pan India, and we have just launched day before yesterday in Delhi. So it will take another 10 days to go, cover the whole of the city. So I'm sure you will soon get it.
Thanks, sir. Thank you.
Thank you, Jagveer. We'll take the next question from Akshata Telisara. Akshata, please go ahead.
Yeah, hi. Thank you. Thanks for the opportunity. A couple of them have been answered. Just one last thing, the JV that you announced a couple of days ago with Morris, if you could just give some more color on when would that be a part of the revenue, whether it's FY24 or 25?
I think yeah, definitely we will start our operations within this financial year, but the real numbers would start reflecting.
And I mean, any initial estimates on how much would that be?
So I would still like to wait for another quarter to give some guidance on this association, because we just signed and we are getting the first 2 molds in this quarter, and so yeah, I just like to wait for another quarter.
I think just to clarify, doesn't include this particular
particular
part of the business. Yeah.
Particular business, yeah.
Okay. Okay. All right. Thank you.
Thanks, Akshata. The next question is from Namant Satya. Namant, please go ahead.
Yeah, hi, sir.
Hi.
So one question on your volume growth for first half. So there is a decline of 3%. You did impact. So what's the kind of volume growth we've seen in the first half in domestic business?
Do we have the volume growth? You can share. Yeah, Namant, I don't have this handy, the volume numbers. So we can inform you one-on-one.
You can get back to us on any one of us, and we will be able to.
So, but would it be safe to assume that domestic markets have grown in volumes, or would that also
No, the domestic market has grown as even in the Q2, we grew by 12.5%, and so yes, we are growing in the domestic market, and definitely the Q3 would be better than Q2 because we already have some new products which were due for launch and already launched in October.
Secondly, on Linc volumes for Linc brand particularly. So I mean, while Uniball is growing, Linc is sort of degrowing, right, in volume terms. Again, I don't know how much of that impact is due to exports, but is there a sort of defocus on Linc and cannibalization from Linc to Pentonic that's happening?
So Namant, yes, and we don't mind that, because the Linc portfolio is mostly below 10 rupee portfolio, and and it is also low margin. So even though we like to grow in Linc, but if a part of this is cannibalized by Pentonic, we do not mind.
Got it. And sir, interestingly, you mentioned that the 10 rupee price point, I'm not sure if I understood that correctly, but the 10 rupee price point, the brand strength is not as much at the 10 rupee price point. Was that statement correct? Did I hear it correctly?
So what I mentioned was that this pens below 50 rupees, they are brand agnostic. So what I mean to say is that if our product is not available, if somebody asks for a Pentonic and Pentonic is not available on the at the retail point, it's easier for the retailer to switch him from a Pentonic to another competition brand. So this is what I meant to say. So it is very important for any brand owner to be available and visible at the point of. So yeah, that is our endeavor all the time. Nevertheless, all said and done, we have a huge, in terms of loyalty, we have a huge loyalty for Linc and Pentonic from our core, target group, which is students. So if and more particularly, this loyalty increases when there is a special occasion like exams. So during exams, they would not like to try any other pen, and they would like to try their brands. So there are many products in Linc and Pentonic, and the same case is even with the competition, that some of the brands of competition and of Linc, there is a huge loyalty, even if it is a 10 rupee product.
Sure, sir. So, and last question would be that in the pens industry, obviously we've seen for the last 2 years, the price points, price hikes have been quite significant, and have exited the ₹5 segment, is what I understand, and moved to probably 7 or 10 rupees. So a bulk of this growth has come on the back of mix improvement or price hikes, however you want to put it. So going forward, the guidance that we have given, what is the kind of volume growth we can expect? If you could help me understand volume growth, and what would be the mix/price hike element in this?
So, Namant, what I understand that while the value guidance is about 7, the volume growth, of course, we have calculated that, but right now it's not very handy. But definitely, we are looking at at least about 8 to 10% of a volume growth to achieve this 17 to 20% of a value growth.
Sure, and that's better than what we've done historically, given Pentonic's launch.
Yes, of course, yeah.
Sure. Okay, that's all. Thank you.
Thank you, Naman.
Sir.
We'll take the next question from Gaurav Somani. Gaurav, please go ahead.
Yeah, am I audible?
Yes, you are. Please go ahead.
Sir, if I heard you right, you said that this financial year will match the revenue which we did in FY23. So if that is right, we are looking at a 9% growth in H2. Is that what it is?
Sorry. I think we're talking about matching the export revenue.
Second half, I thought you said that to meet second half of this in FY24 will do the revenue of FY23. Is that right, or what are we looking at?
So, Gaurav, yeah, for exports, I mentioned that while we have lost some export revenue in the Q2, or let's say collectively in the first half, we would like to, we will be able to recoup that loss in the second half. As a result, we would be able to match the last figures by the end of this financial year.
Okay, so the 17-18% CAGR revenue guidance which you're giving is on what base, basically? Starting Q3 or FY25? Can you just put it out clearly?
FY23 base.
On FY23 base, we'll do 18% for FY24.
Yeah, so The base is of course FY23, and as I mentioned in my address that we are looking at a CAGR of 17 to 20% in the medium term. So we might, so by 25, at least by 25 we should be able to see that kind of a CAGR. Yeah.
Hello. So sorry, can you hear me?
Yeah. Yes.
So sorry to press on this point. Essentially, if you are looking at 18% CAGR growth in FY20,
that would not be CAGR because it's from 23. So that you are talking of an annual growth. We are not guiding on FY24 yet. We are guiding on the 2-year CAGR of 18 to 20%, 17 to 20%.
So Gaurav, further clarification that we are saying that we are looking at a CAGR of 17 to 20% by FY25, but definitely to achieve that kind of a CAGR by FY25, we have to do a good job in FY24 also, which should be not very far from the guidance.
essentially that's the asking rate goes 30% in the next 2 quarters if you are looking at a 17 to 18% CAGR in FY25.
If we achieve 20% growth in the H2 compared to last year, we will be very close to our guidance.
So my second question is, last quarter also your growth was quite subdued. Still you maintained the 750 CR revenue guidance. This was just basically August when we had the last phone call. What changed? And you maintained the margin guidance as well. In fact, even in the press release which you issued to the VS yesterday, the 750 crore revenue guidance was maintained. And today you have changed it. Just want to understand what has changed so dramatically in 2 months.
I'll just clarify that in the first quarter, it was too early to change the guidance because we needed to get a clear picture of where the year is moving. So we can't be changing guidance every quarter. But this quarter, after the export kind of pullback which we got, we thought it was prudent to give the guidance, revise the guidance. That's why we have upfront revising the guidance now.
Sorry to say, sir, but this is extremely bad in terms of signaling to the market. Dramatically, in fact, the investor deck which you sent to BSE also had a 750 crore number. So
that is not 750 crores, sir.
I can show you. I'll tell you the deck number as well if you want to. But anyways, I don't want to press on that point.
No, let's clarify this. Let us clarify this, Gaurav.
Yeah, sure. I'll give you the slide number if you want to.
Yes, sir. Please see, but that is 7,500 lakhs.
For Delhi.
That is Delhi. 7,500 lakhs for Delhi stationery business.
Sorry, I apologize for that.
Okay, not a problem. Many other investors also got confused, so it's not a problem. Yeah.
Secondly, sir, on the EBITDA margin. Okay, so just to continue, sir. Last quarter you maintained the EBITDA growth margin as well. So, and that has dramatically dropped this quarter. So again, as an investor, I'm pretty confused. And I would appreciate if the management can answer. What has changed, and appreciate you given both in last quarter as well. So being aware of that fact and still guiding for an EBITDA growth is something not
Gaurav,
right.
Gaurav, I got your point. This second quarter has been actually a little extraordinary because one reason is that our export revenues, as you know, dipped drastically, and our margins in exports are at 5 to 10%, depending upon market to market. So that is the main reason that our EBITDA was pulled down. Besides the one-time bonus which we gave in Q2, there was no bonus in Q1. So these are the this is the main reason I would say. And
Yeah, so this 150 bips in EBITDA increase, we are target on this.
On
So that,
on the last year,
on
the
last year. Yes.
so essentially, we're looking at a 14% EBITDA in FY25 is what you're saying.
like that. Yeah, right. Yeah.
Thank you, sir. Thank you, and wish you all the best.
Yeah. Thank you, Gaurav. Yeah.
Thank you, Gaurav. The next question is from Sanchit Narang. Sanchit, please go ahead. Sanchit, you need to unmute yourself and go ahead.
Yeah. Is it audible now?
Yes, you are. Please go ahead.
Thanks for the opportunity. Please excuse me if I ask repeated questions. I joined the call late. So what is the FY25 guidance that you are giving right now?
17 to 20% of the CAGR.
Okay. And regarding the EBITDA margins?
About 150 to 200 basis points over FY23 margins.
That would 150 to 200 in FY20. Sorry, what I understood.
Yes, you're right.
Okay. And if it's possible, can you let us know what is our domestic EBITDA margins if we exclude the exports part?
Do we have?
Maybe not the EBITDA margin. That's difficult, but we can tell you the GP margin would be about 5% to 6% higher, right?
So yeah. So actually, we have to work that out, but that export margins are always 5 to 10% higher than the domestic margins. And in domestic, of course, we have different margins for different products. But yeah, I think we would prepare it before we have the next interaction.
Okay, thanks a lot. And one another question is that are we looking any since there is disruption in Middle East, so are we looking in any other countries or export exposure?
Yeah, Sanchit, since you joined late, I already explained that we recently, signed an agreement of distribution in the North America with a national distributor, and so this happened only in the second quarter, but and the first shipment has already been shipped in the month of October. So this is going to mitigate losses from such geopolitical issues.
Okay, thank you, sir. That's all from my side.
Deepak ji, there are a couple of questions on the Q&A board. May I take them?
Yeah, please do. Please do. Yes.
Lohit Saini is asking, what is the current advertising expense as a percent of revenue? Do you plan to increase it for new launches?
So just I'd like to be more specific on this. Ad spend in the Q2 was about 3 crore rupees. So when you look at the overall sales, it comes to about 2.2%. But as you know, this spend is mostly in the domestic market. So of our domestic sales, it would be about more than 3%, between 3.5%.
Lohit, I hope that answers your question. Another question is from Manali Gala. We are unclear on the guidance the company is giving. Could you please give numbers rather than a percent?
Sorry, come again.
We are unclear on the guidance the company is giving. So basically the guidance, the Manali is asking if we can put it in absolute numbers rather than a percent.
Oh, well, I think it's very easy to calculate that the base is FY23 numbers, and we are looking at 17 to 20% CAGR in the medium term. So I think it's very easy to calculate, and as you know that there are always, I think it's safer to be in the range rather than giving an absolute number. So we like to follow this.
So just to clearly clarify, FY23 is the base. Yes, and CAGR growth by FY25.
Yes, right. So I think it's very easy to calculate. Yes.
Chinmay, have you been able to fix your audio issue so we can try taking your question?
Or if we can type it out.
Yeah.
Is it better? Is my audio better? Can you
Yes,
hear
it
me
is,
now?
Chinmay. Please go ahead.
We can take a shot.
Yeah. Thank you, sir. Thank you for the opportunity. Firstly, could you talk about what are the barriers to entry when you look at a new geography to establish footing in a new market? And then I can get to my second question.
Okay. So entry barrier, first of all, you're talking of geographical, right?
Yeah. So yeah, just trying to understand what you're doing in North America, and similarly, how does it work in other geographies as well?
We're talking about overseas, right?
Yeah.
So entry barrier, for a country is quite challenging. It's not very easy to enter a market like US. When you compare it to markets like Africa, there is no entry barrier. You could simply go and offer a competitive price and a good product. And so as such, there is no entry barrier. But when it comes to market like US, it's very difficult to promote your own brand, because most of the exports to the US from India and China party brand. So you call it white label exports. And as a policy, Linc decided that we would not like to do white label or a third party brand exports. So that's why we've been struggling for last 5 years to crack or to find a distributor who would be willing to distribute under Linc or Pentonic brand. So there is a high entry barrier in a market like US. And just to tell you that even though find a distributor who would be willing to distribute under our brand, we have already been on Amazon.com in the US for these 5 years, promoting our Pentonic brand, and which was doing reasonably well, or which is doing reasonably well there. I hope I've been able to answer.
Yes, understood. And secondly, my question is about the longer term turnaround strategy presentation or annual reports. I read that you've said that a consumer who could pay 5 rupees for a pen 20 years back can easily pay 30-40 rupees for a pen now. So is it that we are taking a general price hike for the same quality of pen, and that is what is going to drive the growth, and that is what the turnaround is? Or are we changing our product mix to a more premium product? Because
Chinmay, I've got a question. Quickly to answer, it is really very difficult for any FMCG product, even a pen, to increase prices so radically. So we can increase by a few percentage, but we have to launch or design a new product if we want to upsell to our existing consumer. So we have to launch newer products.
A 20 or a 30 rupee pen is really not a new thing. So is it fair to say that the growth guidance that you've given would largely come from an increase in market share? Because the pen industry, in usual, even your company, the long-term growth has been what, 5 to 7% or larger single digits. So is that fair to say?
So yeah, of course. If you see historically, the growth has been quite mediocre. But as a Pentonic was for our company, and of course also for the industry, the growth is actually driven more by value than by the volume. So I just answered a question of one of the participants that while we are looking at about 8 to 10% of a volume growth, the value growth is going to be around 17 to 20%.
Okay, got it. Understood.
Because of the premiumization.
Thank you, Chinmay. Friends, we'll take the last couple of questions on the Q&A board before we wind up. Jagveer, you had a question. What is the strategy for the US market? I hope Deepak ji has already answered it. In case there's anything, please let me know.
And Naveen, sorry, yeah, please carry on. Yeah, Janvi, carry on.
Sir, so any target for the expected sale from USA? Because our own brand, so what is overall strategy now? Because USA is a very big market for this.
Yes. So, sorry, what's your name?
Jagveer. Jagveer Kausdar.
Oh yeah, you were already there, right?
Yes.
Okay, so
this is a follow-up question.
So Jagveer, on my right is my son Rohit, who is looking after exports. But I thought that I would let him answer this, but I will take this up. And globally, in our category, this is the largest market. So, we have been after this market for last 5 years. And as I mentioned, we have invested more than $500,000 to crack this market because we wanted to sell in our own brand. So finally, we were able to crack and find a suitable distributor who is very large in the US. And so we have very ambitious, projections from the US market. To not reveal right now because of strategic reasons. But I believe that the American dream, which we were dreaming for many years, should happen, in the near future.
Sir, one more last question or suggestion, if you can allow, sir.
Jagveer, please go ahead, but make it short.
Yes, sir. So, sir, because I am a very long-term investor, so I do a lot of sculpture and go to the stationery shop. So, this is suggestion, or you can say, so can we learn something from the domes, because in the last 5-6 years they have done a lot of innovation in the packaging, so we can make more colorful pens or some more designer pens.
Jagveer, you will see this very soon. We are actually, when we launched Pentonic, our positioning was very premium, so it was purely a black pen, but launching variant of Pentonic which are more colorful, both in product as well as packaging, to attract the school-going children. And even though the black pen was or even is liked by the student segment, but I'm sure this colorful range will increase our market share. And yes, so you are absolutely right.
Thank you, sir.
Thanks, Jagveer. Okay, the final question for the afternoon from Pankaj Jain. Morris JV is only for Indian markets, or will it be a manufacturing base for exports?
So it will be a manufacturing base for exports, as well as we will also be selling in the domestic market.
Thank you, Deepak ji, for taking all the questions. Now I hand
Yes.
over you for your closing remarks. Sanjeev, please do the honor.
Thanks a lot, Naveen, and thanks a lot, participants. Really appreciate your time and wish all of you a very, very happy Diwali in advance. Thank you.
Thank
On
you,
behalf
Naveen.
of- Thank you, Deepak ji. On
Nice
behalf
to
of
see you
all
later.
of us at SKP, thank you very much, Deepak ji, Dujari ji, and Sanjeev for taking time out to interact with the investors. We look forward to hosting you again for the next quarterly webinar. And a happy Diwali to all the participants. Thank you and have a wonderful day.
But the